again and welcome. Thank you for joining us on our market insights and opportunities. Today is June 14th of 2022. And let's get right to our special announcements. You know, I've been off last week. I was out at an international conference in Florida. I was asked to speak and present at the Insight ETF conference, and it was well attended, well over 2,000 people. It was great to get back sort of on the conference scene, and there's a lot of great knowledge that we brought back here for our clients, for our team at Blanke, Schein Wealth Management. But I also presented on the 60-40 portfolio, if you will, and the question mark, is it dead? And it was really well attended. Well over 2,000 people were at the conference, and we had over 200 people in our room when I presented. And there was well attended, and the reason why is it was the topic du jour, because this year, for the first time in a long time, both stocks this last quarter and bonds this last quarter were down. Now, a balanced portfolio, a diversified portfolio, well-built portfolio is supposed to be sort of weathering the storm. And our portfolios here at Blanke, Schein Wealth Management have done just that. It's almost like managing the downside is most important versus then capturing the upside. And that's what we spent our time on, building balanced and diversified portfolio. And that's what we spoke about to the audience. But ultimately, it doesn't happen when just both stocks and bonds go down in the same quarter right now. Now, why is that, and what's happening right now with the market? Well, ultimately, we have the Federal Reserve is way behind the curve. This is not a secret. We've known this. We spoke about this a year ago here on my daily updates. If you've been following along, I appreciate if you have. A couple of side notes right now. Next week, I'll be on the Claimant Countdown on Monday. So if you want to tune into Fox Business just before 1 o'clock, I'll be on with Liz Claimant Show. And then on Wednesday, we're going to have Blanke, Schein Wealth Management Market Outlook. And so we're going to have a webinar. You can join us next Wednesday at 10 o'clock Pacific Standard Time. If you can't join us, we'll have a following link to basically watch it at home at your leisure. And so those are important. It's more than just a 5-minute update that I give you here. It's basically where we are, but more importantly, where we believe we're going. So please tune into those. That's the webinar next week, and Liz Claimant on Monday, if you see fit. Monday's off, the market's a holiday, but I'm still going into the studio. Not in New York, I'll be here in the Palm Springs studio here, but I'll still be on the show itself. But why are the markets going crazy? Market's gone wild. In fact, the 10-year Treasury, as we film this right now, is just under 3.5%, and that's significant because last week it was just under 3%. And so Friday we had the CPI report, Consumer Price Index report, and just showed month over month, it went from 8.5 to 8.6, so it's accelerating. Inflation's accelerating. Well, duh, you don't need anybody to tell us that. I mean, I go to the gas pump, I go to the kitchen or the grocery store and look at the kitchen table, with everything there. Goods and services are going up. And so that's inflation embedded in our economy. And the 10-year Treasury is saying, hey, short-term interest rates, Mr. Jerome Powell, Federal Reserve Chairman, who's just kicking off a 2-day session today, who we anticipate a 50 basis point hike tomorrow. At least that's before the CPI report this last Friday. It was too hot. It shows inflation's way too hot. So now the expectations are 75 basis points, maybe even more, for tomorrow's Federal Reserve. The bottom line is the 10-year Treasury is doing the job of the Federal Reserve. Federal Reserve is slow and steady and sort of very pragmatic approach, very communicative. That's all well and good, but it's not good for the markets. We've seen since January to now, markets are like a 2-year-old that is oversugared and overtired. Right? They're upset, and they basically just need, listen, let's just calm down right now and let's get down to reality. The reality is that corporations are earning money. Corporate earnings are growing at 10% this year. They're projected to grow at 10% next year. So why are earnings still growing, but the stock prices, Rob, are still coming down? They're disconnected. And in the short term, that happens from time to time. In fact, if you look at market pullbacks the last 20 years, 10 times the market has declined in the last 20 years by 10% or greater. Okay, so market pullbacks are completely common, and that's why we build diversified, balanced portfolios. But yesterday, the S&P told us we're now officially closed down more than 20% on the S&P. NASDAQ and Dow already did it earlier this year, but now the bear market territory is gone. It's officially, S&P is closed into bear market. So what is this telling us? Well, the 10-year Treasury is leading the Federal Reserve. They have to raise interest rates faster because of the CPI report, and then ultimately we've got a strong economy. The 3.5 or 3.6% unemployment rate. Again, that's a 40-year low as well. So how is this going to play out? You said there's a disconnect, Rob, between earnings, right, and the market. Well, we own high quality companies that ultimately will get stronger if we go into a recession. We own high quality companies that can navigate through higher inflationary prices. We own high quality companies that pay our clients dividends. You can't fake a dividend. Cash flow is king. And so how are they going to do that? If the top line's growing, so think about this. If you and I both own a business, okay, that's what we own when we own ownership in stock. Okay, and we pick any business. We own a business, and we know our sales are going greater this quarter, year over year. We're growing our sales. Okay, but our input costs, like the cost to get something from point A to point B, because of energy, because of diesel fuel, because of input supply chain, geopolitical. We could talk about reopening, supply and demand effects right now that are all playing out. This is actually a really great economics 101 situation playing out. And my kids at home we're having a great conversation at the kitchen table. It's actually what's happening out in the economy today. But if we have our top line revenue, our growth is happening in the top line. We have our input costs, right? Our wage inflation's inside. Because it's inflated, because it's a tight labor market. Everyone's fighting for talent, so they have to pay more. So then inside our balance sheet, so top line's growing, inside the balance sheet, we have to pay more for our goods, services, wages, so on and so forth. The net on the bottom is going to decline. We have multiple contraction, or our profitability is going down. Okay, what happens? It happens for a couple of quarters. Okay, and then what the business owner, what you and I would decide is say, hey, wait a minute. Do we need all of the employees that we have? Or do we need or how can we basically manage the balance sheet? So we're already seeing, if you read in the Wall Street Journal right now, especially Silicon Valley, they led last recession, they're leading right now of all the sectors in the S&P 500. They're starting to lay off, or at least hiring freeze. So this number will start reversing. It's going to start taking off the wage pressures in terms of the balance sheet. Or you and I say, hey, wait a minute, if you and I just tighten up our bootstraps and do a little extra overtime here and there, we might not need the extra employee. Therefore, sorry, just not going to work out. And then you and I will pitch in and we'll make it happen until times get better again. And that's preserving the bottom line, or the profitability. Why do I say that? Why do I make that analogy? Because corporations, on a public corporation, or the CEOs have one job, right? The C-level executives. It's to manage the shareholders' expectations to profitability to the shareholders. So why I have confidence in the future is, yes, we're going through a recession. Yes, we're going through earnings are coming down because of all these concerns of unknowns, inflation here and there. Inflation's not going to continue. Federal Reserve will get ahead of this. Demand destruction will happen. There's going to be a point in time where when higher prices are too high, you and I are going to say, nope, I'm not going to chase that. You can have it. I don't want that car. You can have that car. You can overspend for that, airline ticket. And ultimately, the market will work itself out. But top line earnings or businesses are growing. The middle of the balance sheet is going to be managed effectively. I firmly believe that. And the profitability will be there for the shareholders. We've had a lot of conference calls with a lot of these corporations, and the CEOs and CFOs have said just that. Read between the lines. So this is a moment in time, a short-term sort of contractionary pressures that are building. But I believe that we're closer to the end than the very beginning of this. And I think the 10-year Treasury is leading the hand of the Fed. And ultimately, all we need is the Fed raising the rates and getting to where they need to be, and some cooling off of the economy by way of wage inflation or inflationary pressures, or energy coming down, or something, let's say some geopolitical sort of wins. Let's say the war in Ukraine happens to have a sort of a happy ending. We can all pray for that at that moment in time, right? But there's got to be good news on the horizon. We believe that that's going to happen sooner than later. That's why you stay invested. In fact, one of the things that we had also from First Trust right now is looking at the last 42 years going back to 1980 and showing when the markets drop down. Now, I don't expect you guys to see this in great detail. I'll just describe it to you. But ultimately, it's last 42 years showing when the market has been down greater than 10%. In that period of time, there's been a trough. And so basically that negative point in time, ultimately, let's say, I don't know if we're at the bottom yet, but we're getting pretty close, kind of feels like it, with markets being down but more than 20% respectively. Again, our clients are relative performance, so we're weathering the storm better than markets, but that's why we have a balanced portfolio. But that being said, you're winning by not losing, right? So you want to be there when we have a bounce back. Now, you got to stay in it to win it. And so what this chart shows is the next 1 year, 2 years, and 3 years when you get to the bottom of the market. Again, we don't know if it's now, we don't know if it's at the end of the summer, but we're in the bottoming process of a bear market for sure. And so what happens the next subsequent 1 year, 2 years, and 3 years of return? Well, on average, this last 42 years shows a period of time of 18.5% average decline, if you take all of those combined together. And then the subsequent year, 1 year return from that decline is 24.9%, so just under 25% rebound. And then the next year is a 17% rebound, and then followed by the third year of a 12% rebound. And those are the averages, okay? And then the green lines right here, they're the outliers right now that don't fall in line with regards to the last 42 years, but they're still listed, meaning that the next 1 year, 2 years, or 3 years, there were greater sort of declines in the markets. And any guesses at home what years or periods of time that was? Yes, 2008, the great financial crisis. And then 2000, the dot-com bubble. So 2000, 2001, 2002, but it started in 1999 here on this chart. That being said, the odds are looking good in our favor. And are we in a dot-com bubble? Well, maybe crypto if you're in that, but our clients aren't. And if you're, 2008, is this a 2008, once again, with regards to real estate? I don't believe so. Banks are well capitalized. Consumers are well capitalized. Again, consumers can find jobs right now at that 3.6% level right now. So we believe it's different in the sense the economy is a little bit different, a little bit stronger. And there's cash in the balance sheet of corporations, cash in the balance sheet of individuals. And then the debt to income ratio is a lot better than it ever was in those two periods of time. So yeah, the economic backdrop is different. Now, that being said, I want to say thank you for watching us today. I could go on for quite some time, so I would encourage you to tune in for my 1 hour or less webinar next Wednesday. And again, if you can catch me on Fox Business next week, I appreciate it too. Again, like, subscribe, and send to friends and family. But you guys have a great day. And let's see what Jerome Powell does tomorrow. Is it 50 or 75? He should be doing 75, maybe even more. We'll see how it plays out. Thanks for watching.